Hey, this is Eddie Gartner, Epic Financial Strategies. Appreciate you checking out this video. Today, what we're going to get into is we're going to go through an IUL illustration. There's a lot of information that's out there on YouTube, people talking about the infinite banking strategy. Some people are leaning towards whole life insurance, others are leaning towards IULs. In the way that I was brought up in the business and my understanding of products, I usually tend to lean on the side of whole life insurance. I think foundationally, it's a much better product, less moving pieces, less risk that you're introducing into your world. But I'm going to go through an IUL illustration to kind of show you what one looks like. Not to say that they're good or bad, but I want you to see what people are being shown out there in the general public, what the industry is showing them, and the pitfalls that could arise if you're not vigilant on these types of policies. So let's get into that today. So first thing that we're looking at here is we have a 32-year-old male, right? And this is a client of ours that was sent this illustration from another company. And what he was looking at was funding $2,500 a month into this policy initially. So $30,000 a year going into the plan. And he's going to start out with a $2 million death benefit. And on top of this, he has the ability to fund an additional $50,000 into this plan. And you'll see exactly what that looks like as we continue to go through this illustration. But if I just stop there, the first thing I want to say is, based on the client, this is totally outside the realm of what he can do, right? Based on his income, what he's earning, this was totally above and beyond anywhere that he would be from a comfort level. Now, what they'll tell you in IULs is that there's flexibility in the premium, and there is, but that can be a bad thing because if you're building a policy that you're trying to overfund and accelerate the cash value of, but you're able to really reduce the premium down to a very small amount, that becomes a real problem long term. Because as I'm going to show you later on, the cost of insurance in this product never goes away. As we dive into this, we had this $2 million death benefit, $2,500 a month. And the way that he will receive interest rate credit is through the S&P 500, where he's able to participate in that account at 100% participation rate. What that means is your money is not actually in the S&P 500. What they're doing is they're going to credit you interest based on the S&P 500. Well, how much interest? Let me show you that. So here we go. On this policy, you'll see the index crediting strategies, right? And so for this person, they were looking at the monies going into the S&P 500, 1 year, 100% participation. That means you get to participate, and what the insurance company does is they track that index. So if you start this in October of 2024, when October of 2025 rolls around, they're going to look at where was the S&P when you started, where did it go to, and that difference will be the interest rate you're credited, right? Up to a cap of 10%. But here's where the problem really starts, is that cap rate can and will change. Insurance companies often change their cap rate. So what do they say? They say, well, we're going to guarantee you that the cap rate will never be lower than 3%. If you're not listening carefully, you may think, oh, I can never earn less than 3%. That's not true. What this means is that in some years, if things get really bad, the most you'll be able to earn is 3%. Now, I don't know that the rate has ever gone down to the guarantee, but I do know that those interest rates change, and they change dramatically. I know some companies that we've worked with where they were offering 12 and 11% interest rates, and a couple years later, they were down to 6%, right? So those things and those fluctuations and changes in IULs, if you don't understand that risk, can be devastating to the policy long term if you're not going in with the right mindset. The other thing is there's a floor rate. That floor rate is 0%. And so what the people that sell IULs will tell you is that you can never lose money. This is true in the sense that you won't earn negatively, right? You can't lose money because the market performed poorly. In 2022, when the S&P 500 was down 22%, what happened in the IULs? They got a 0% crediting rate, right, in this particular one. So these are things to be aware of, that you are going to have 0 years of earning interest, right? You're not going to stop the cost of insurance that's always going to increase, but you are going to have flexibility and you have that upside potential. And that's what you're looking at when you look at these IULs. Let me go a little deeper into this strategy, because as I was talking about, the way that this was designed, and I think this is a shame for people to even show these types of illustrations, this is not something that the client can do. And they clearly didn't do enough deep diving into what the client's actual goals and objectives are. But let me go into what they're showing. And this, to me, is one of the things that I just think is not a good strategy at all. So let me remind you, the client who came in was coming in looking for a bank on yourself policy, right? And in that strategy with bank on yourself, what they're looking to do is put money into the policy and loan that money back out to themselves to go and do something other than the life insurance, right? They may invest in real estate. They may finance their own debt. There's many different things you can do. And with all the changes that can happen in these policies, that's one of the main reasons we don't like to use these, because they're less stable, less foundational. But as I get into this, what I wanted to show you is the premium outlays, right? So this client is looking at, and again, remember, this was $2,500 a month, $30,000 a year that they're looking to put in, with a $50,000 dump in, that's $80,000 in the first year. And if you look at the year-end values in this column, the IUL has a accumulation value of $77,000. But that is the money that you're getting interest rate credit on. That's not what you actually have access to. And in this strategy, they only have access to about $33,000 of that surrender value, and a nice death benefit here. What you'll also see as we go through this is each year, as they pay that $2,500 a month, $30,000 a year, they're taking additional loans against the policy. And what they're doing with the policy loans is not investing in other assets or financing their own debt. They're purchasing more insurance inside of the policy. So this annual premium here in the second year is $60,000. 30 of it came from the loaned amount from the life insurance. The other 30 came out of their pocket. And this strategy continues on, where each year they're taking a loan. So in this year, instead of borrowing 30 from the policy, they're borrowing 60. In the following year, they're borrowing 60 again. So you can see two $90,000 premium payments. And then here, after 5 years, they're borrowing $120,000 from the policy just to, borrowing $90,000 from the policy just to make these premium payments. And what's this doing? It's greatly accelerating their death benefit. But look at this cash value. They have a $253,000 loan, and they have access to about $172,000 of cash value. If you go further down the line, what they've done is they've put in a total of $1.2 million into this plan between monies that they borrowed from themselves in this policy and reinvested into the policy, and brought their death benefit up to $5 million. Their cash value, money they have access to right now, is only about $445,000. And this all looks really good. And then how they show it to them is, after that point, you're 33, you do this, then at 43, you could start taking out, in their words, $36,000 a year, almost $37,000 a year, income tax free. And that looks really good, right? In their mind is something that you can do continuously. But remember, you have to earn money in these accounts for this strategy to even work. And they have no thought of ever paying back the loan in this strategy. So you got to ask yourself, how feasible is it for them to get all this money for years and years and years out of the life insurance? So this is just showing the non-guaranteed value. What I'm going to do is dive in a little bit deeper and really get into the details now. But if this is something that you've been looking at and you're thinking, man, that really sounds awesome, this IUL thing sounds really, really great, but it almost sounds too good to be true, and you want to have somebody take a look and review that policy, this is what we do every day. So this is something that we can talk about, and we'll tell you how to do that at the end of the video. So as I dive into this, right, there's a couple different options here in the IUL. So there's a guaranteed, there's the non-guaranteed that they're currently illustrating, and then there's an alternate scale. And what this is saying is that the guaranteed interest rate, like we talked about before, is 0%. right? Highly unlikely that the S&P 500 would return 0 over a 10-year period. Highly, highly unlikely. But the non-guaranteed assumes that you're getting a 6.3% rate each and every year. And the non-guaranteed, or the other non-guaranteed rate, shows a 4%, right? So the maximum they can illustrate is this 6.3, but they're going to show you what happens if you get 4%. And what you can see here really clearly is that the guaranteed policy doesn't even make it to year 10. The policy has no death benefit, no cash value to sustain this sort of strategy. If we go to the non-guaranteed at 6.3%, well, everything works beautifully, and they reach their $440,000 cash value, and they're pulling money out every year, and that policy is in their mind kind of self-sustaining. You're gonna have this $5 million death benefit, and this cash value you're not gonna have to worry about. But what happens when you get those 0 years? Because you're not going to get a 6.3% rate of return on the S&P 500 every year. It's just not going to happen. In fact, in the last 10 years, I think there were probably about 3 years where there were zeros in those return numbers. So if you have zeros in those return numbers, you're going to have a much different picture that you're looking at. And to show kind of the sensitivity to the interest rate, look at what happens when they earn 4% each and every year. Well, that policy runs out of value with this strategy by the time the client's age 50. So they barely make it. They don't even make it 20 years with the policy. So again, these are things that I think you need to go into with eyes wide open. You need to be able to understand that there's a lot more complexity to these policies and things for you to be aware of, and it's not just a set it and forget it thing. Not to mention the fact that whoever showed the client this policy never actually listened to the client to find out what they wanted to do. This strategy is really taking all their money and reinvesting it back into life insurance with no intentions of ever paying that down. If you're doing the infinite banking strategy, the idea is to take that money from the life insurance, allow it to continue to grow in the life insurance, but leverage it into something else. Something else could be financing your own debt. Something else could be taking and making an investment. And the cash flow from that, or the debt payments that you would have been paying, you should be pushing back towards the life insurance to rebuild that available cash value. You don't want to become your banker. You don't want to utilize the infinite banking strategy with the mindset that I'm never going to pay the loan back, because that's not going to work, right? You have to be adherent to the strategy that you're putting together. And those are things that we can help you do. So if you like this video and you want more information about what you should be doing specifically, maybe you've looked at some of these illustrations, maybe you're not really sure which way you should go, sit down with an advisor here at Epic. If you go in the description box, put in your information, we will reach out to you. You'll be able to book a calendar appointment right there. Go ahead and set that appointment, and we will sit down and walk you through different policies. And the first thing that we're going to do is really learn who you are, learn what you're looking to do, and then find the right strategy. Because again, IULs are not necessarily a bad thing, but when they're put together not properly and they're sold in a way that you think this is the magic bullet, I can assure you it's not. So let's sit down, let's talk about it. If you like this video and you found value in it, go ahead, give it a thumbs up. Please share it, subscribe, and stay tuned for the next video.